Advisors got rewarded for the traditional 60-40 portfolio the past 6 years, and that seems to be coming to an end. We're seeing some of the volatility come back into the markets this year, concern about where interest rates are going, what's the future direction of equities, articles today about how businesses are seeing a slowdown in their business models. So definitely the time to look to expand that asset allocation into alternatives, things that can help in a more volatile environment, things that can help in a negative equity environment, the things that can protect the portfolio in a rising interest rate environment. It really comes down, what are you trying to achieve? Are you trying to build wealth? Are you trying to preserve what you have? If you're a younger person, obviously you have a much longer time horizon, you can be a little bit more aggressive, and you can look to things like global macro strategies or private equity strategies, assuming you qualify for those that have above average growth potential. If you're an older investor, I think you need to be looking at things like market neutral strategies or even managed futures, to the extent that managed futures historically generates really strong returns in a negative equity environment. Things that can help preserve the corpus of your portfolio in a volatile or negative equity environment. The advent of liquid alternatives, meaning alternatives in mutual funds and ETFs and UITs, has been great for investors. But there are some strategies that don't fit in there. I mean, part of the why they call it liquid alternatives is because you're able to get in and out much more quickly than in the historical private placements, be it a daily basis in a mutual fund or intraday in a ETF. So there are some strategies like private equity, direct real estate, some event-driven type strategies that really need to be, that are fundamentally illiquid and should not try to be jammed into more liquid structures. And that is a general caution that I have. When you have strategies that are fundamentally illiquid, I think they should stay in a liquid, wrappers or structures. And because if you try to jam them into a more liquid structure, you either end up taking liquidity risk or you end up watering down the fundamental nature of the strategy.